Hello and welcome to the quarterly results analysis for Avenue Supermarts. We'll be looking at the results for Q4 FY19. Let us start with the P&L numbers. When we look at the graph on the left, we see that the company managed to sustain a decent revenue growth of 32%. The expense grew in line with revenue growth at 32%. The graph on the right hand side shows the growth in revenue for over the past 5 quarters. Q4 was one of the better quarters for the company. When we look at the EBITDA numbers, EBITDA grew at 28% to 377 crores and PAT grew at about 22% to 203 crores. PAT growth was disappointing. The graph on the right shows the EPS growth. EPS followed the PAT growth at about 21.3%. With respect to the expenses, the line item purchase of stock in trade provides details on the amount spent by the company to buy the products from its suppliers. It grew by 32%, which is again in line with the revenue growth rate. By the way, the item makes up 87% of the total revenue earned. The graph on the right hand side shows the growth in other expenses. Other expenses includes a gamut of things like contract employee, that is in-store employee salary payment, lease rentals, store operation costs like electricity bills, repairs and maintenance, legal fees, travel expenses for key employees, etc. Other expense growth was on par with the revenue growth. Let us now look at the balance sheet. I am showing only the significant items in the balance sheet and omitted other non-important items. I have highlighted 4 items in bold and green that are important and need attention. With respect to our assets, the major component is the property, plant and equipment. In case of Dmart, this comprises of stores that the company has built. In FY19, the company spent 1040 crores to construct 21 stores. I'm not sure if the Dmart ready stores are also part of this number though. The other component of non-current assets is the capital work in progress. Capital work in progress indicates the money spent on stores that are still under construction. Substantial sum was spent in FY19 on ongoing projects, which should see the light of the day in FY20. Among the current assets, inventories form a sizable portion of the assets. I'm not surprised with these numbers though. With increased store count, the company is expected to have a higher inventory number. Among the liabilities, the major liability is the shareholder equity. On the borrowing front, both the short-term and long-term borrowings for the company are minuscule. Now, for a company, if its major assets are its plants, property and equipment, and if its major liability is the shareholder equity, then isn't this a reason to celebrate? A shareholder cannot ask for anything more. Overall, the numbers on balance sheet are very encouraging. Let us now turn our attention to the e-commerce venture of the company. Avenue Supermart delivers the online orders via pickup stores called Dmart Ready. They also deliver the goods home for a nominal charge. E-commerce is currently restricted to Maharashtra, Mumbai and its suburbs to be specific. The company would like to perfect the model in one place before opening up itself to the wider audience. The results of Dmart's e-commerce foray should be looked at through the lens of its Dmart Ready pickup stores. By the end of FY19, the company has 196 Dmart Ready stores in Mumbai. This is a growth of about 237% from FY18 when it had stores of about 58. The P&L numbers seem to closely match the Dmart Ready store growth. For example, total income grew by 223% to 144.2 crores, which matches the store count growth as well. Now the cost of goods grew closely at 212%. So if you look at the revenue growth and the cost of goods growth, this clearly shows that the gross margin in this business is thin. Employee expense grew at a much slower rate of 25.4%. Other expenses grew at a moderate pace of 42%. Due to lower gross margins as well as due to fixed costs like employee expense and other expenses, the EBITDA was negative. Depreciation further worsened the situation and the PAT came in at minus 50.8 crores. These numbers were a revelation to me for the following reasons. A. Pickup store growth seems to be intertwined with the revenue growth. If this observation is true, then it is a clear indication that Dmart online customers prefer the pickup route compared to the home delivery option. If pickup route is the way to go for Dmart, then Dmart will need to set up huge network of pickup stores to shore up its revenue. Since operating margins are less, the fixed cost becomes crucial for the company. The company will have to either find a way to reduce fixed costs like employee expense and other expenses, or it needs to ensure that the operating profit is more than the fixed costs. I did some calculation and I believe that the e-commerce venture might turn EBITDA positive when its revenue increases to about 700 to 750 crores. I'm expecting this to happen sometime in FY21. You can go through my article on investing.amitkirti.com to check the computations. Now let us look at the P&L number for the second subsidiary, that is Allied Retail Trades Private Limited. Allied Retail is responsible for the private labels of the company like Premia. The revenue growth for the subsidiary is in line with the parent at 31.1%. Growth in cost of goods sold is very close to the revenue growth at 30.7%. Again, this clearly shows that the gross margins are very less in this business. If you take out the fixed costs like employee expense and other expenses, the EBITDA is minuscule and one can safely ignore the PAT for this subsidiary. The EBITDA margin is 2.1% and PAT margin is 1.2%. This came as a shock to me. I was expecting private labels to bring in more profits. I have a feeling that the parent company, that is Avenue Supermart, accounts the profits of Premia as a part of its P&L, and this subsidiary makes a nominal profit. The management later informed in analysis meet that staples are not part of its computation for the private labels. This explains the reason for the paltry profit margin of 1.2%. The third and interesting subsidiary is Avenue Food Plaza Private Limited. It is responsible for managing the food counters outside the Dmart store. For example, the softy ice cream, sugarcane juice and the sweet corn counters that we see outside the Dmart stores. Though the revenue is minuscule, I am surprised with the EBITDA and PAT margins. The EBITDA margins are 32% and profit margins are 23%. Compare these numbers with the other subsidiary, Allied Retail. To achieve a PAT of 5.7 crores, Allied Retail had to generate revenue of about 700 crores, whereas Avenue Food Plaza could generate the same PAT with revenue of mere 24 crores. Indeed, there is no business like food business. In summary, revenue growth was a positive development. PAT and EPS growth was disappointing in this quarter. Store count growth was disappointing again, but then if the decrease is due to delay in regulatory approvals, then one can't do much about it. Performance of the subsidiary was satisfactory in this quarter. Overall, this was a very sober quarter for the company. I am expecting FY20 to be a much better year for the company. This was an abridged version of the results of the company. Please read through the detailed review at investing.amitkirti.com where we look at some more aspects of the result. Thanks for listening.